What's up, team? Sean for Us to Live. And no surprise, we're going to do a little bit of a talk here about a breakdown in earnings from Palantir for Q2. Earnings came out this morning, a little bit of a mixed bag. I think there was a lot of massaging of graphs and charts to make things look great. And I think that's part of the job of any company. I think there's some things in here that are a little bit concerning. I've got some question marks, and then I want to talk about really what I would consider the biggest glaring problem across the business, and one that is unfortunately repeating itself again and again. And until I hear something on the front that we're going to get into, I'm going to be really continuing to be concerned. So real high level, before the markets opened today on Monday, and today is the 8th for anyone who's not watching this today, Palantir reported their second quarter earning results before the markets opened, right? And the real sort of key takeaways here, they did show a loss per share, which was not what was projected, but they did actually beat on revenue, which was great. So let's just touch on the high level. Then I want to get into some real details here. Then I want to get into some of the weeds. I approach this in a way that most people who do these types of assessments or readbacks don't do. I live and breathe in this world. I've launched divisions at big companies that are focused on driving analytics growth. There are a lot of ways to flex and massage what we're going to talk about today. And I'm going to actually call some of that out because I think that the way that you understand this can be very different based on what your background is and how you understand the way you would launch a company and run it like this. So super high level before you get into all that, right? Here's the actual key components that I'm looking at, right? Earnings per share, we saw a loss of 1 cent versus an expectation of 3 cents. Doesn't sound like a lot, but that difference between a loss and a positive, it matters. And that's really what hit the shares this morning when the market opened. We did see a little bit of recovery back over $10, but there was quite a big hit right when the market opened. Now, on a positive front, revenue was $473 million versus an estimated $471.3 million. So not a crazy beat, but a good beat still. And overall, revenue for the quarter increased 26% year over year. So good comparison to last year. And commercial revenue grew at 46%, right? So again, we were looking for that. We want to see strong commercial growth, continued commercial growth. And additionally, in the commercial space, I'm just calling out some highlights here that I have notes on. We saw a 250% year over year growth. So they're up from 34 commercial customers to 119, on a comparative basis. So I think that a big part of what we heard initially, and this is coming from the CFO's perspective, the miss on earnings was due to a decline in investments in marketable securities. Again, anyone who watches these kind of videos on a regular basis knows they got beat up bad on those SPACs. I think those were questionable decisions in the first place. That's coming home to roost. And that overall, on a positive note, commercial growth was very what he called widespread. Typically, when we think about widespread, we think across industries and sectors. We think across different sizes of businesses. So it's good to see both that horizontal perspective as well as that vertical perspective and how we understand those earnings. I'm going to spend some time towards the end really talking about Karp and his letter and my just utter disappointment and continued disappointment, if I'm being frank, in the positioning and talking through what the future beholds, because it's not good and it's actually really frustrating. And essentially what Karp, I'm going to take out the highlights here. Strength and momentum we are seeing with customers in the United States is a reflection of the refinement and maturation of our software platforms. We believe will continue leading to increasingly broad adoption across sectors. I think what we're expecting for Q3 coming out of Palantir today as well is that they're going to have revenue between 474 and 475 million for the third quarter, and between 1.9 and 1.902 billion for the full year. So missing that $2 billion mark, I think that's a huge error to make that call. I think they need to double down and find their way there, because I'm going to tell you right now, from my perspective, I need to see that $2 billion mark. It's important. It shows a extreme level of growth. They got to find a way to get there. That's my take on it, and that's what I need to see here. Now, one thing, just to be totally fair here, that does make this business tough is selling government contracts is not a linear motion. There's a lot of ups and downs. There's a lot of unknowns. There's uncertainties. The way they buy can shift based on a lot of different factors. So I'm okay with not being exactly sure where we're going to be, and I'm okay with missing here and there. But overall, as we stretch this out, as long as the trends are trending the right way, then we're generally okay. So that's that. What I want to do is I want to share my screen and actually share with you here what I'm looking at and kind of the things that I'm paying attention to. So we're going to go over two things. I want to do a quick run through of the presentation that was done today, and then additionally, I want to jump into the shareholder letter. Again, I know there's a lot of people who cover this, and I think that they cover it in a way like they're reading analytics for the first time. So I want to go a little bit deeper into what some of this stuff means and why it's particularly important. I had warned in previous calls that my fear is not to confuse customers signing up for a pilot or a 6-month trial with being net new business, because although it is in theory net new business, it's not indicative of retaining that large business. So there's some numbers in here about that. And overall, I think my take is there's a lot of backwards looking in here. I want to see more forward looking. But let's jump into the weeds and see what we've got. Excuse me, 1 second while I pull that up. Okay, cool. So I'm going to, again, cover this real quick. I don't want to go too into the weeds. I think a lot of people have, but there's a couple of really key things in here that are not going to be covered the right way by a lot of folks who do these kind of Palantir updates. And I think the perspective is that they don't work in this business. They don't understand finance. They don't understand analytics. They don't understand go to market for analytics. So it's very hard to give your opinion on something when you don't have that baseline understanding. Simply analyzing a company does not give you the ability to understand what some of these things mean. Okay, so I want to keep that there of why I take my time to do this rather than rush through and read some metrics off of a sheet. So again, this is the Q2 update. This is from the company. Of course, I'm going to call it out here that this in no way am I affiliated with this company. I have no business with them. I don't do business with them. I am not compensated in any way, shape, or form. I only own a couple thousand shares. I'm somewhere in like the mid-range $8 price per share. I also play this in leaps. And I'm in those leaps at $7.50, just so everyone knows where I'm at. So this downtrend has not affected me really at all. I could sort of just see it as another opportunity to play this long term. And I want to be totally clear here. I am not a trader. I don't trade this. I'm looking at the long-term vision, which is why my frustration is so high coming out of this call, because I don't mind if it takes another 2, 3, 4, 5 years. But we need to hear things that indicate how we're going to do those things, not that we're going to do those things, okay? So as always, what this screen is really saying is don't make any decisions on things you don't know. They're making statements within their report that could be forward-looking, not proved out yet. They could be projection-based. So, of course, you need to do real research when you're investing in any company. I'm sorry to say that for people who don't like hearing that, but you have to do that. And this is my assessment on results, not financial advice for you. You have to know your own portfolio and risk factors. So, of course, like any good company, they do a great job with their presentations. So I want to call it out. A couple of the highlights they have in here, which hard to disagree with. Revenue grew to $473 million in Q2. Customer count increased to 304, which is up from 169 a year ago. These are phenomenal numbers. U.S. business generated more than $1 billion in revenue and 42% growth over the prior time period. So the other piece they call it too is U.S. commercial revenue grew 120% year over year. Again, I think these are great numbers. I don't see any reason why they wouldn't call these things out. Their overall revenue growth was sub 30%, but still that U.S. commercial range is really what I care about the most anyways, and speaking to that is a huge deal for me. And this is a presentation that they put on, so they want to put the best foot forward on every piece. So I don't want to speak to everything in here. You can easily go and check this out on their website. But I think this is a good sort of culmination of the fact that they're working across a lot of very serious, very deep data integrated areas, right? So I'll let you all read this on the screen. I won't speak to everything on it, but I think it's just a good call that their sector and industry expansion is obviously actually happening. We know there's a big push into healthcare. I dealt with this firsthand in my time at IBM, where we really made a big push into healthcare as well. That didn't work out at IBM. So it's going to be curious to see how they play this a little bit differently. It looks like they're doing really well here. This is an area of excitement for me personally. And I want to see them keep focusing on this area and keep proving out that it's doable and it's profitable and it's going to work long term. This, though, is really the piece that I just love. As someone who lives and breathes in this area, these sort of concentric growing circles in and around TAM is so fascinating to see. And I want to call it again, if you haven't heard some of these terms before, TAM is total addressable market. This is, in theory, the total market that exists for the products or solutions you're selling. And as time has gone by and they've added more feature functionality, et cetera, into their products and solutions, that TAM keeps growing bigger and bigger. And the way they break this out across sort of the different components, Gotham, Foundry, and Apollo, was really interesting. And I think what's particularly interesting is you can see how Gotham is sort of following a very linear growth pattern. That makes a ton of sense. They're focused on contracts. They're very focused on the government side of the business. Foundry, which is really heavily in the commercial sector, you can see how with some things that are being added on here, with M&A, with additive products and solutions, they can have major growth within these TAMs. And same with Apollo, right? As that commercial market usage grows, they can really explode in size. The one thing that never gets talked about ever, and I want to talk about it right now, is the idea within TAM is what we call SAM, the serviceable addressable market. It's easy to say that, hey, if I have an ice cream company and almost everyone likes ice cream, then my entire customer base is everyone on the planet. There's 7 billion potential customers in my TAM. Well, okay, sure. But my serviceable addressable market are those customers I can actually service meaningful in time in the near term. So I'd be curious to see what anyone watching this thinks that their serviceable addressable market is. Is it just US commercial customers based on the size of their individual teams they have in-house today? Is it bigger than that? Those are the questions I'm asking, doing my research on personally as I look at these things. Again, a lot of new products have come out since they went public here. This is a weird slide for me. It doesn't add any value to what I'm looking at, but hey, if you like it, you like it. Of course, my computer naturally is going to run an update right now as I'm recording, so sorry about that. And again, right, look, we see more and more of this focus in and around SaaS companies. This is just presentation material. These are the things I'm too concerned about. I'm going to skip down to the stuff that I really do care about here, though. Again, I see these kind of things all the time in my general day-to-day. It's great. They've got native multi-tenancy. They can work across a lot of different clouds, a lot of different functionalities. They can drop applications into different areas. They can overlay within what we call sort of our layer cake architecture, where we understand data, pipelines to data, operating systems, application systems, whatever it might be, how we stack them together and connect them across those pieces. They're basically saying, like, look, we can work throughout or have a high degree of throughput the entire architecture. So a really important piece here. Here's the one thing that is, this is an interesting quote that's very positive, but I want to speak to why it may not be as positive if it's not executed the right way. So the future built on Foundry. This is what AWS was in the last decade. Foundry will be in the next, for sure. AWS has massive organizational sales teams with a high degree of focus, and they're bringing in a lot of people. I know that Palantir is as well. That's why I'm also generally excited. But with that comes other pieces of AWS that don't get mentioned as much, and I want to call out here shortly. And it's this right here. So usage-based pricing, or sometimes what you'll hear people in the industry call elasticity, elastic-based pricing. This is really great in a lot of ways, but it can be very deceptive in other ways. I want to call it out here. So usage-based pricing, right, enables IT to buy Foundry with a clear, transparent model that scales in predictable ways relative to usage and value. Sure, that's a great description. And it enables partners to more successfully drive joint sales and deliver projects. So I love this. Any good company who's delivering in this sort of fashion, they need to offer elasticity in their underlying product usage. What this means is some months or time periods, I need to use a ton of power. Some times of the year, perhaps, maybe I don't need to use as much power. So you think about it very much from the AWS example in the previous screen. Maybe for an energy company during the hottest months of the year, I'm really focusing on looking at and understanding electric grid, electricity usage. I'm really powering analytics at scale. Other parts of the year, I don't need as much. The problem with elastic-based pricing or usage-based pricing is that it is, in fact, very flexible. And although good on one hand, it means that customers can very easily cut their usage and their spend at a moment's notice. Now, if you're thinking to yourself, well, yeah, but if they're successful and things are great, they're not going to do that. Well, that's true. But this also means that the degree of focus on account management, on product usage data, on general Foundry usage data as well, and how do we keep these customers happy? This means you need to have not only customer service teams, but extended customer success or CX teams as well. This means more staff. This means more people in place. This means more non-revenue generating people in the organization. Now, none of those are bad things that I just said there, but I want to call this out again. Retention on contracts and contract utilizations are important. Usage-based pricing as a model is very tough to manage for almost any company out there. And for those who don't know this, across all of my friends who work in CS and CX, I can tell you for a fact, not only is it extremely difficult to find people who want to do this job. It's even harder to find people who have the talent to do it, because these are the folks who are going to deal with the customer success issues, product issues, upgrade issues, anything that's going wrong. They're going to have to hear about it, ensure it's recovered and fixed in a meaningful amount of time. There's typically going to be what's called SLAs. These are service level agreements that says, for example, anytime you put in a request for support, we have 3 days to get back to you. If you're on, a higher price point, or it's built into the contract, or you have some special agreement with us. Every company has different versions of this. We have 24 hours to get back to you. The problem is more and more commercial customers come on board, which is great. And as an investor, you love that. You have to service those customers within timeframes that are pre-agreed on. And if you don't, it can start to hurt the bottom line. It can start to hurt sentiment. It can start to hurt attrition and churn. So the issue at play here is oftentimes we talk about net revenue retention. We talk about customer acquisition costs. We talk about churn and attrition. Churn is when we lose a customer. Attrition can be from 0 to 100%. We might lose 5% of the spend, 20% of the spend, 80% of the spend. It's important to understand and recognize those differences, because with usage-based pricing, you can suffer natural attrition in spend that there's nothing you can do about. Customers may not always be growing. They may need to shrink at certain times of the year. This means that even for customers who are shrinking their spend, you have to give them the same level of support. I don't think this is a big deal, but I think a lot of people who might have watched earnings or listened to other videos on this, you're not getting all the facts here. Usage-based pricing is a great way to help them grow more folks into more offerings, and it also means potentially smaller price points, which means more people can get on board. But it's not as sticky, right? It's easier for me to get off of this product if I know I have it. And I know they've called out customers who left have come back. I think that's great. I just want to make sure I'm giving you both sides of this. It's not all roses and butterflies. Sometimes there's issues and we got to pay attention to those. I think this could be one of them, although it's also very exciting in a major, major positive move. But just remember, this isn't just about salespeople and managers. This is about customer success, customer service. This is about understanding SLAs. This is about understanding expectations. This is about having clear, concise messaging around how to cut, when to cut, what cutting will look like. Are there going to be bands of elasticity? There's a lot that goes into this. I'm sure they've thought about it all, but as an investor, you need to think about it too. The other piece here that's kind of cool, right, is they're obviously getting serious about listening to the people who are talking about them. I, by no stretch, am one of these people, nor can I be. But there are a lot of people who are majorly working within the developer space. There are people who are really putting out information out there. I think that's great. This helps people do their research. This helps to give a lot of perspective as well on what else is going on, how people are doing this, and different ideas in and around research. So just a good positive slide, nothing crazy. I don't want to spend too much time here because I know it's going to be covered by a million people. But look, for the U.S. business, they generated 1.04 billion in revenue. This was a 45% growth rate from Q2 of 21 to Q2 of 22, right? So that's great. Not bad, right? They've eclipsed 1 billion for the first time. We can see here in a couple of quick slides. And again, I'm talking quickly about this because they're very obvious. I don't think we need to go deep into some of the stuff. We're talking quarter over quarter, by the way, in both pieces here. Government revenue growth was 13%. Commercial revenue growth was 46%. I will tell you why, though, this is more exciting than a lot of people might realize. Q2 is definitely the second best time of the year for customers to buy, typically in the commercial space. Most customers, I do this for a living, are buying in Q2, but the majority of companies are seeing their spend in Q4, okay? That's when procurement has budgets. That's when they're buying for the year ahead. This fact here, for me, is a really great number to see, because a growth rate of 46% in Q2, it's just significant. It means a lot. It makes me feel very comfortable about the potential to perhaps outperform even with lowered guidance. Net dollar retention of 119%, right? Obviously, this is still great. We saw our Q2 revenue grow by 26% with a year-over-year 473. We already discussed all these numbers. And again, this is great. I want to make sure that is not changing over time. It's got to be very linear to slightly up and to the right, okay? It's a big deal that we continue to retain customers. This one's really interesting as well from a year-over-year perspective, an 80% growth rate in customers. Now, it's easy to look at the negative. The negative could say, well, what if a huge majority of these customers are very small, they spend very little? And I think that for sure is one way to look at it. I'm going to choose to look at it not optimistically, but from the fact that this could simply be that more customers are on pilots, more people are trying out and working with the software. And that's going to be my take on it. They kind of call it out here, and I know you can see it, but they have continuously grown this over the time periods that we have here on the screen. And I think that's just a general good positive thing. So nothing negative to add there. Commercial customer account has really gone up. Average revenue per top 20 customers is up. That's great. That speaks to growth. With that, I actually should spend a moment here. One of the biggest issues with growing your business and growing your top customers is they start to want to restructure contracts to get lower and lower pricing. Because, of course, if you're a huge customer, you want specialized treatment. And that's deserved most of the time. But the fact that we're still seeing this growth rate in the top 20 customers, it's a good thing. That means that even if they are decreasing pricing, they're increasing size and scope. So as long as we see positives there, we're going to be in good shape, hopefully, for the time being. Deal close are way up, billings slightly up, all good stuff. There's a backlog of deal value, which is really interesting here. So they ended Q2 with 3.5 billion in total remaining deal value, up 4% year over year. Sort of like, I think this is spun up to look really great. I wouldn't think too much about it, but overall, it's still a positive thing. And again, here from performance obligations grew as well. Great, good things. No problems there. Gross margins are pretty standard. In the 80s. I think if you're looking at this and the 83 versus 81 is concerning, this is one of those ones that could easily be overthought. I'm not worried about adjusted gross margins. They're in the 80s. Those are phenomenal margins for any company in the world. They're investing in their business. That's great. No need to go crazy here, right? Free cash flow from operations, still looking good. I want to just call this out because this is one of those things I almost wanted them to show this at the very beginning of the entire presentation. I'm going to call it out anyways. Ended the second quarter of 2022 with 2.4 billion in cash and no debt. I mean, based on the current market cap, assuming low 20s at the time of recording this, they're about 10% in cash to market cap. That's pretty wild. And that cash is going to end up getting deployed somewhere eventually. So you're going to see some probably non-organic growth is my guess from a revenue perspective as well. And of course, here you can see in July 2022, they closed a $450 million delayed draw term loan. So they have an undrawn credit facility of $950 million. So I think it's important that people understand what this is indicative of. I'm not claiming to know what they're doing with it. I don't know what they're doing with it. But what is being said here is we already had $500 million sitting on the shelf that we can grab anytime we want. We've added another 450 million to that for a total of 950 million that's available and accessible when we need it. And they've got 2.4 billion in cash and no debt. Okay. And it's interesting to say because they've got 950 million in accessible debt, but they haven't used it. That's why they have no debt. I think about myself. I think about if I was the CEO or CFO of Palantir today, and I need to massively explode my TAMs, my SAMs, my overall revenue, get over $2 billion in total revenue, and really project it into a place where it can be the next Amazon. You know how I'm going to do it? I'm going to have a ton of money ready to rock and roll on the shelf so I can start to massively go out and buy competition. I can buy the pieces that are missing. I can acquire and merge where I need to. And I think that with valuations way down in the overall market across the board, both public and private, I think that if I was sitting on this kind of cash, I'd be very excited and shopping. So I don't have any information on this at all. This is completely conjecture and opinion. I would not be surprised to see them continuing to acquire companies at scale here. I think it would make a ton of sense, and I think it would really help to boost those overall revenue numbers. And I think that could be a catalyst here that really blows into the future. Now, time-wise, et cetera, I have no idea. I don't pretend to know either. But they're not taking out almost $1 billion in credit facilities just in case when they're already sitting on 2.4 billion. Do you get what I'm saying here? This is for purpose. This is purposeful. Now, we don't know why, but it's purposeful. And let me tell you something else too. Even strong companies don't just get unlimited amounts of undrawn credit facilities for no reason. So they're telling their bankers something or what they need this for, and they're getting the money. So again, this is just being predictive about this, but clearly there's something at play, something we should be paying attention to. So there's a lot of other good stuff in here, right? Good growth, good numbers, all the things we're expecting to see here. Here's a little bit of what I think I'm perturbed by, but what that previous piece on credit facilities and cash can really get into. So for Q3 2022, they're expecting revenue between 474, 475, and adjusted income from ops of 54 to 55. These were not the numbers I think the market was looking for, and I think this is part of the reason why we saw a big hit initially based on the earnings that came out as well, besides just their earning per share. And the overall full year for 22 guidance is revenue between 19 and 1902. And again, adjusted income from ops of 341 to 343. Look, I'm going to say what I'm thinking here. I understand that this is what their guidance is. I don't like it. I don't like where they're coming in from a numbers perspective. I think they need to find a way in the next 6 months to do everything they possibly can to get this number over 2 billion. So part of me is wondering if there's some headwinds that they're not being clear about, or if there's potential opportunity to under promise and over deliver. I don't know. I think they're obviously not pulling these numbers out of the air. Of course, they're based on real metrics, but they can see their forward-looking pipeline. They can look at their pipeline ratios. What this means is they might have, I'm going to make numbers up for the sake of conversation. Maybe they've got 2 billion in total pipeline. They have a typical expectation that 25% of pipeline reaches close rate. So that's why at about 474, maybe that's where they're trying to come in at, and that's what their expected closure rate for that quarter will be, and that extends over to that full year perspective. However, I think that if we're sitting on that much cash and we have the opportunity to find ways to increase that near-term sort of overall revenue, I'd like to see them do something with it. I think the $2 billion mark is a major catalyst for these guys. I'm not saying to do bad deals. What I'm saying is we need to get creative in understanding as a company. If this was my company, I need that to get to 2 billion, or at a minimum exceed the 1.902 I'm calling. And I would not be surprised if that's the expectation here, or even after Q3, we see revised earnings again, or guidance again for the full year. So that's just my rough take on it without a whole lot more to add. I'm not going to jump into all the stuff down here. You can certainly read it yourself. The other thing I want to jump into here is the letter to the shareholders. When I said there was good and there was bad and there was ugly, this to me is the definition of ugly. And I'm going to be very frank here. I'm kind of getting tired of it. I play things for the long term. I always do this. This has been very successful for me financially, career-wise, my life in general. I don't care about what's happening in the next 5 hours, in the next 1 week. I'm looking at things long term. That's why I get excited, as you could probably tell, when I go over these presentations. But there has to be either strategic or tactical or some sort of an explanation as to the how. Okay, the TAMs are massive. Great. What are you going to do about it? Okay, you have elasticity in pricing. Okay, great. What are you going to do about it? So in the letter to the shareholders, I feel like we're still living in a realm where we're very much, I don't need poetry. I don't need beautiful writing. I need to hear from the CEO, here is what we are doing, here's why it is working, and here's what we're going to do to make it even work better, right? So Karp's letter, of course, right, is talking about the fact that a new company is emerging within the one they've already built. Okay, and I think this is a really interesting take on it. Starts off well, right? Customers in the United States. We're talking about commercial, enterprise, and government agencies. This is all great. There's willingness of American institutions to experiment with novel software platforms. That's great. Quarterly revenue in the numbers underscores this significant unrelenting growth of our business. Great. All things we already know, all things we can hear from the CFO, all things we can frankly hear from a sales rep who tells the story of where things are today. He also calls out here that a broader shift, if not return to the United States, is underway. Proportion of revenue generated in the U.S. has increased in Q1, et cetera, right? 3 years later. Okay, great. These are not things I want to hear from a CEO. I'm being honest with you here. It's okay to have this in there, but we need to shift into now. We're going to do X, which will result in Y, which leads to Z expectations. This is the part that really got me fired up. I'm going to be very transparent here in explaining it. We believe that our most significant growth is still yet to come. Development of modern versions of our principal software platforms required an extended period of often intensive iteration. Every company on earth can repeat this exact same statement and it'll fit them. That's why I'm aggravated. It says nothing. Both commercial and government sectors need to determine how best to address their needs. Okay. We've only recently begun to capture the value. Revenue generated by news clients, for example, was nearly equivalent to the entire amount of revenue generated from customers acquired. This is standard growth. This Again, like instead of Palantir, I could name almost any company in the world at this stage, and this exact explanation would apply. That's why I get frustrated here. It's not indicative of something big. It's just repeating things that are obvious that you could learn at business school and put any name against, right? It's all good stuff, but it's good for anyone. Okay. Again, like I just want to call this out here as I keep going. I've read the entire letter, but right, 12-month period that ended, recently 12-month periods, years of investment, new high growth software business has emerged. Okay, then why are you calling down full year numbers? Why are you not saying you're going to hit 2 billion? Like, these are very generic things that any software company on earth is going to say. I'm not even criticizing that they've done it all. It's great. But like, Alex, it's time to really get and say, here is what execution looks like. And even again, as we get into later parts of this, right? Trend is even more pronounced when assessing recent growth of adoption. Great. Commercial business generated 300 million in revenue. Great. Related developments, right? We're seeing former customers coming back to the platform. Great. Right? How are customers returning because they've tried other options? Great. All good things, all great things. Show me a company that can't say the same stuff, exactly the same stuff, because many of them are. Excuse me. So again, here's even more, right? Software products and platforms are at the center of much of the world. Of course, we know that, right? Apollo's a standalone offering. I myself have said this a long time ago that I believe this was going to be the case, that I did an entire piece just on Apollo about how it needs to be a standalone offering that brings its own value to customers as a data pipeline tool. I've said all this. I'm not the CEO. I'm just some guy on YouTube who does this for a living. I shouldn't be able to know more than he knows. And it should have been months ago we talked about this. Obviously, great demand for large enterprises of software delivery and maintenance solution that's agnostic will be significant. There's tons of people who already do this. Again, I could switch any name out here. Focus in the short term remains on making our principal software platforms available to increasingly broad segments. Generic, right? You getting my theme here? I need to hear very real things, right? I need to hear very real things as to what's going to happen. Now, when he finally gets down to like this perspective of having adjusted free cash flow, we repeatedly decided to raise and preserve capital when others were spending. We just covered that a minute ago. Here we go, the word strategy. Finally, I get to the word strategy. Our strategy in this regard has secured our ability to continue refining and developing our software platforms in order to maximize their value to cut. What? The reason you raised almost $1 billion was to continue refining and developing software platforms in order to maximize their what? That's every company on earth is trying to do this. This is a nothing. There's nothing in here. And I'm a fan, team, right? I'm a fan. I think there's geniuses working here. I think this is an amazingly cool agnostic product. I love the switch to elasticity. I love the results. I love the growth. I love what I'm hearing. Where's the that's not what I want from the CEO of what is supposed to be a major innovative company. We raised money. Wow, why do you have almost $1 billion on the shelf to keep refining and working with our product? Yeah, okay. Who's not doing that? What major company is not doing that? Oh, well, we're really focused on the commercial markets. So is everyone else. Okay, cool, got it. We're really going to go to elastic pricing. Amazing. I love that. That's a growth catalyst. Tell me why. Tell me why that's going to change the market. Now, for those people who come in and say, like, this guy doesn't know what he's talking about. Well, the thing is, I kind of do. I've had my own businesses. I've sold businesses. I know what it takes to grow. It's about being very strategic in the vision. You raise money in the beginning for a large strategic vision, not to say things like we're working and refining our products. We know, man. Alex, you have a lot of fans. Tell us how you're doing it. Tell us how you're going to accomplish it. Tell us the resulting effects of doing it. What will change? Because everything in this presentation was backwards looking. Now, I don't know how many people are going to make it to this point in the video. Probably not a lot, but that's okay. I just want to share this. Long-term players, myself included, are looking to understand and have visibility into what might be in the future. I've shared some of my thoughts here today, but I didn't get enough. I need more. Tell me why you have it. Tell me what you're going to do with it. Tell me what you think you might do with it. Tell me that it's going to be to create easy-to-buy application-based products. Tell me it's because you want to switch to a true SaaS model. Tell me it's because you're getting there and you're not 100% sure, but there's several companies you have your eyes on and you're thinking about acquiring. Great. You can say all the reasons why you can't give more information than that, but it's directionality. Simply saying we're going to continue working on a product and making it better, well, I would certainly hope so, no matter what the situation is. So look, with that, I'm going to stop recording. I meant this to be a really quick video, but I actually really do care and really get into it. So hopefully you watch till the end. Do me a favor. If you did watch to the end, I want you to leave a comment at the bottom that simply says 2030. Just put 2030 in the comment below, and I'll know that you watched to the end, and I really appreciate it, team. Thanks so much for watching. We'll see you again soon. And by the way, I've got a new camera on the way, so we'll finally clean it up. Thanks for watching, everybody. We'll see you.